Welcome to the January 22nd, 2024 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. Whoa, boy, howdy. What they were thinking was absolutely wrong. Now remember, the premise on Bitcoin, and I'm going to show you where they got this Bitcoin premise about the exchange-traded funds. We waited 18 months for the exchange-traded funds to come. Those that love Bitcoin, what was supposed to happen is millions of new investors and billions of dollars are going to flood right into those ETFs that have to buy Bitcoin and push the price up. And Kathy Wood runs the ARK funds. She said, oh, it could go to $1.5 million per coin, right? It's about 40,000 at the time. That'd be a good thing if it happened. But what actually happened is a completely different story. Look at this. This is a world of hurt for the past 2 weeks. So a couple of weeks ago, SEC has a tweet and they said, oh, we approved the exchange-traded funds. There's 11 of them. BlackRock is the one you're looking at. Fidelity has one too. Anyway, there's 11 of them. And then the SEC said, no, somebody hacked our Twitter account, and so cancel that. And then a few days later, they said, okay, the 11 exchange-traded funds that are ready to go get to trade. Boom, off to the races. Well, it's a world of hurt for those that did it. This thing is the BlackRock Bitcoin ETF, minus 15% in the first 2 weeks. That's from the offering price. From the high that day, because Bitcoin went to 49,000, now it's 41,000, it's down 22%. Well, that just looks like hopium, and it hasn't reversed yet. So I don't know what's going to reverse it, but we're going to look at where the people that were thinking that got their thought, right? Their thesis. Here's the thesis. This is the gold ETF. It came out in 2004. It had a miserable first 6 months, and then money just piled in. And of course, the gold exchange traded fund has to buy gold. And it went 4 to 5 times this low down here from 400 an ounce to 1900 an ounce. And it never saw it again. Then all that money came back out and it went to 1100 per troy ounce. Wow. Then it didn't get back over it until almost a decade after it hit 1900. So be careful, because this was 10 years in the desert. That was ugly. And it really hadn't done much, because if you go back to this point, there's basically no money and no income all the way back to 2011. That's 13 years of disappointment if you piled in right here. And it says, well, wow, you should have been harvesting along the way. I don't know what's going to happen to the Bitcoin exchange traded funds, but the premise was wrong. It doesn't look like this, at least not yet. It could at some point. Anyway, we'll get on to some real assets, and here was another fallacy. Net Worth Radio and McGowanGroup Wealth Management bring you this YouTube video each and every week. YouTube, McGowanGroup. Be sure to subscribe, because some of what we do is actually warn people about false premises that can be very dangerous. And I have one right behind me. I'm your financial weatherman, pleased to be with you. You can visit us at networthradio.com, send us an email there. Anyway, this is another fallacy. Remember, if you go back, and this has been true for a decade, everybody said, oh, Chinese stocks. And the Chinese are issuing shares to people like Alibaba, which is not actually a share of the company. It's a share of a Cayman Island holding company with a contract for part of the profits, and they've never had a distribution. 11% is the decline in the Chinese stocks so far this year. Boom, right here. You go back to the peak of the markets back in 2021, this thing is down over 60%. That's the basket of Chinese stocks. So the premise of continued Chinese growth, and yeah, there's over 1 billion of them, and so it's a great market, and these companies make a lot of money. None of that money's made it back to the U.S. shareholders, and part of the reason, of course, is they don't like to pay dividends. They like to keep all the money. They just IPO shares, and they keep the money. So, beware the abacus. All right, this is the Dow, the S&P, and the NASDAQ for the last 2 years. And you can see it's relatively flat. It's a 2 to 3.5% return after this week's rally. Midweek, the market swooned because the 10-year U.S. Treasury, which I'm about to show you, spiked in yield to 4.2%, put pressure on the markets, and there's not really much good earnings news yet. Technology came to the rescue this week with a big Thursday rally. Salesforce drove the Dow to a 200-point gain, and then they added some to it on Friday. Well, what's going to drive this? Well, it's going to be earnings, hopefully, but you're not seeing it yet. This is that spike in the 10-year Treasury to near 4.2%, and that puts pressure on other assets. So that was the primary factor that the week began not as much fun as we thought. All the stocks right here so far that have reported, the banks look terrible. Minus 10% for the financials. They drug the earnings growth down to 3%. The only good news in the banking area right now is they've already reported earnings, and everybody else probably did pretty good. And we'll start to see if these earnings grow. What was the good news? Consumer discretionary, shiny, happy people everywhere. Retail sales had a big spike over the holidays, and consumer sentiment is the highest in about 2 years. So people got jobs, and they're even going to the grocery store, even though the prices haven't come down as much as wheat or corn. But that was a superstar. The other is materials. We'll keep you posted on the earnings reports, most of which will come out over the next 4 weeks. And if that starts to grow, as it's projected to, you could see a big spike. Earnings are projected to grow at 20% between now and the end of 2025. If Ed Yardeni, our source on that, is correct, and he's been pretty good in the past, that would be extremely good as the Federal Reserve begins their cycle of bringing rates back to normal. Those valuations could go way up. This is the overall value of the U.S. stock market. Hit $49 trillion. This is the Wilshire 5000. That is basically the credible publicly traded stocks. Now it's 48 trillion. Just to put it in perspective, you're not back over 2001 aggregate value of stocks. But there's $8.8 trillion in money markets, and those yields are likely to come down with the Fed. As that happens, people look for a choice. So I want to give you a perspective on what could happen over the next 2 years and how to prepare. You can reach us at networthradio.com. McGowan Group Wealth Management, a team of 10. We serve affluent families right from the Crescent in Dallas. You can set your time for a Zoom call or come down and meet the team that cares. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.